Hey everyone, welcome to Dr. Frank's Finance World. I am Dr. Frank, the bank, where I try to teach you a little something about finance so you can put more money in the bank in the future. So please be sure to subscribe or notifications. We're in the 30s number of videos now, and there'll be more coming in the future. That way you can know when new stuff shows up. Might find it interesting. Look in the notes and links for websites. We're pulling those in as we go, and then check out our books in the bookstore. There's a lot of really good ones in there. So in forming portfolios, it's always worth kind of considering what they call factors or anomalies. Early in the research, they called it anomalies. Now they tend to call it factors. But the idea is there's maybe something in the market that can teach you how to look for those characteristics and do a little better in your portfolios and your investments. So it became important after the original market efficiency research. We talked a little bit about French and Fama and all that, and that formerly in the finance world, that's called CAPM. But then, the idea was that the returns of stocks were related to or correlated to the returns of the market, and by running a regression and getting the line of the relationship, the slope called beta, you could actually figure out how stocks moved relative to the markets. That's all you needed to know. Hip, hip, hooray. Everybody knew how to value stocks now. But there were some problems. They started running research and finding out, you know what? We could get a better model if we started to look at other factors that would come into it. And so the other things that started to show up became part of what was known as the French Fama three-factor model, which was very, very popular, still used in academic research to some degree. And the three factors are the market, as well as small firms tended to do better. Some people say that that's due to data in the 80s, but I'll show a report at the end of this that says that's not necessarily true. And firms that are selling close to book value. And then more showed up beyond that. So this whole factor smart beta thing came into being. I went and pulled the anomalies for you. This is a couple places you can go look, but it's pretty doggone good. And I'll go there and look at those now. When we talk about, where is it? Stand by, here they are. Okay, if it will, the computer's fast enough. So when we're looking at making sense of anomalies and that type of stuff, there's lots of different ones out there. This first article on Investopedia, it's a pretty good place to look stuff up, by the way, talks about making sense of them out there. And they put them into different categories. For instance, calendar effects, which are things like a weekend effect. Friday tends to be the best day, Monday the worst day. There's a turn of the month effect that they sometimes call the payday effect, because everybody has money taken out for their retirement there, and so new money comes into the market every month. The turn of the year effect, which some people have said is tax effect, but it really isn't. At any rate, it could be, the Christmas rally, the January effect, that kind of thing. And then formerly the January effect was one of the calendar events, but we talked about that already and said that's not really a whole lot of help many times. So why do they occur? Who knows? But there's lots of little reasons for tax reasons, selling for losses and that kind of stuff. But at any rate, another area of anomalies deals with announcements and anomalies. So stock splits. You would think that a stock would have a 2-for-1 split and it would simply be cut in half. But what they find in research is there's about a 7% gain typically from the time the split is announced to the actual split itself, although there's some after that. But basically, you can make a little money off of stock splits. And that keeps happening and happening. A short-term price drift. We talked about that in a couple of different models that looked at leading into announcements and how they do afterwards out there. And I even went so far as to say, if I find a company that has not done well, unless I have a very good reason to keep it, when they miss their stocks, I'm predicting it's going to drift lower, especially for the negative ones. And I sell them. That's one of the reasons I might sell. Merger and arbitrage is another one, the buyer and the seller and all that. There's a bunch of superstitious ones, which are kind of funny. Which conference wins the Super Bowl in a year. Hemline, that high hemlines mean people are happy, and low hemlines, big long skirts, not so much. More aspirin they sell and all that kind of stuff is just some different types of kind of odd anomalies. And the interesting thing is they call it an anomaly, but to me, from a research standpoint, there has to be cause and effect. Just because they're correlated doesn't mean there's cause and effect. When I went through the PhD program, they talked about, for instance, you tend to have more shark attacks in the summer. You also tend to have more people eating ice cream in the summer. So do the sharks attack the people because they eat the ice cream? That kind of a thing. You really have to have a reason why it might actually be worth considering as a data point or as an anomaly before you're going to use it. This is one of my favorite places to go to, Investor Home here, because they talk about, CFA Gary did this. They have a bunch of summaries of a fundamental analysis like low price to book or sales, low price to sales, low price to earnings stocks, neglected stocks, and international evidence on that. Technical indicators like the technical stuff I put together for you out there. Those are somewhat anomalies. Calendar anomalies we just talked about, others and so forth. There's a value line one. Are we really data mining? And that's kind of the question. Is it an anomaly that's only specific to a certain time period and it won't really hold up through time? And the ones that I've chosen to follow are the low price to earnings, the PEG ratio one, and the low price to book, because they seem to persist through time. But there's other ways, like we talked about when you look at the research that says, hey, look at the accounting side of it too, that suggest you might be able to do a little better. And in the end, one of the fun things about me, at least for getting to me for being a finance professor, is I'm kind of paid in a sense to look at new papers that come out and look at new research and think about how that might fit into a portfolio sense and how that anomaly may or may not repeat again in the future. So every little one that I decide to keep, in my opinion, puts the odds very slightly in my favor. And if I do that enough times, I feel like it's my best chance to beat the market. So going back to the PowerPoint then, we saw that there are these anomalies out there, but the question is why, and why is this part of forming portfolios? Well, like I told you before, is it really data mining or not? Or is it something that persists through time? I picked this up about probably 6 or 8 years ago, but Zacks is a service that actually is very good at finding healthy firms versus not healthy firms, and they give buy-sell indicators, and you can go sign up for that if you want. But they did a really interesting research paper. There was a period of time in the market from the very end of the 90s, the beginning of the 2000s, through about 2010, where the market actually had a negative return, and that had never happened before over a 10-year period. And it was actually that time period in the worst possible market that Zacks ran their research and said, well, if anything's going to be data specific, it would be now. And they ran their sort of research on it, and this is what they found. So they looked at winning value strategies out there. And if you want to look it up, you can find Zacks T5vs.pdf. You can find out there yourself. A statistical analysis of different multiples. The things that I think, the thing that I think is the common variable in all this, when you look at the anomalies or you look at valuation methods, is price to cash flow, price to earnings, price to sales, price to book, and it's price to earnings scaled by growth. So everything is ultimately related to price. And so whether anybody says, oh, we use price or we don't use price, they have to use price. It's part of the valuation process. But at any rate, the test was to look over this time period. They had to be over $1 a share. They had to have a 20-day average volume of 100,000 shares, something that trades a fair amount. Using one we call pin the base screen, produce a pretty good compounded return. So, but the first one was price to cash flow. And in downturns like the market is kind of at the end of 2022 and the beginning of 2023, you are focus a lot on cash flow of firms. So the price you pay, the multiple of cash flow you pay is kind of an important thing. And what the basic research showed over the 10 years of the study is the price to cash flow. If you bought firms that were not expensive relative to cash flow, you had a 17% average return. And the higher the multiple you had to pay for cash flow until you got to 40 times cash flow or greater, you actually lost 7% a year. So this basically said that the cash flow, you want to keep a low price to cash flow. And this is not in the 80s, and it's not specific to anything particularly. So anyway, it's interesting to me how they set this up. But they did something else that I really like, which is they also considered the accounting aspect of this. Why? Because Zacks the service is pretty good at that. So when you layered on top price to cash flow, firms that also had a top rating from Zacks went from making 17% a year to 34% a year. Didn't change much because these guys aren't going to have any top ones out here. But, it's interesting that you could do so much better, basically twice as good, if you actually considered firms that were healthier financially. So then you look at price to earnings ratio. Low price to earnings ratio, and by the way, you can screen for these in FinViz. Low price to earnings stocks have tended to do better. So what did they find over they called it the lost decade, the dead decade from 2000 to 2010? Low price earnings firms earned 21%. High price earnings firms lost 6% a year. This is per year, basically. So it's quite a difference when it's all said and done out there. Now, what would happen if you found the healthiest of the price earnings, low price earnings? You actually found that, sorry about the yawning, I'm tired tonight. The low price earnings ones that had the top rank went from making 21% to making 26% a year. And this is what they call monotonic on most of these, where the further out you got on the multiple, it was kind of a straight line down and you got lower performance. Price to sales, which is typically used for firms that don't have earnings, but price to sales, the low price to sales firms over this decade earned 17.8. The high price to sales earn 7.9 or minus 7.9. So once again, the low price to sales firms did well. Put accounting on top of it, and they went from making 17% to 34%, once again, like some of the other stuff you saw. Buying the low price to book firms, the firms that are selling pretty close to book value, would have earned you 12.6 and 12.9. And the reason why this looks a little different is a number of the firms that actually sell below book value have some pretty serious issues. They have lawsuits against them and things like that. So this doesn't surprise me as far as this being an anomaly. But what's interesting, once again, is for the 0 to 2, you can see they combined it in this one down here. With a rank of 1, once again, you got a 31.3% return. PEG ratio is the price earnings scale by growth. You tend to like to keep it below 2. The low firms where you weren't paying that much for growth, this used to be called growth at a reasonable price, or GARP back in the day. But once again, the low PEG ratio firms also did better, 18.2. Buy the better ones on accounting, and you're actually earning 26%. So this was a pretty interesting study to me for two reasons. A lot of people have tried to poo-hoo the anomalies and say it was specific to a certain time period, and here's a time period that they've never looked at before, and they get the fact that they layer accounting on top of it, which I think is a great idea, and suddenly you have returns in a decade that had negative returns of 20, 25, 30% a year. So pretty interesting stuff. Not the final word, but something kind of interesting. So the books here that I would suggest is The Intelligent Investor by Benjamin Graham. Kind of an old school book, but remember this, Benjamin Graham was the majors professor for Warren Buffett. So value investor out there. And then this Winning on Wall Street, Martin Zweig, that's also one of my favorites. So lastly, from a research standpoint, just throwing this out there too, if you look at, they talk about beta. We talked about beta in this where we run a regression. Every single variable in that regression equation has a coefficient estimate, which says how the stock moves relative to that, or the return of the stock relative to that. And each of those is known as a beta. And a lot of times they talk about, you combine portfolios. We're talking about foreign portfolios. You combine portfolios and you lower the volatility of the portfolio. And this would sort of make some inherent sense, right? Because one moves up and the other moves down and so forth. But the problem is you would also think that the beta would tend to coalesce towards 1 because it tends to act more like the market when you get things that don't move perfectly together. But not true. They showed basically a number of different studies here found a higher degree of beta instability in portfolios formed from randomly chosen stocks relative to beta instability found in individual stocks. And one of the things that I do in my classes is if you run, take Walmart or anybody out there, and the returns of Walmart, and we will go over this when we're doing benchmark, the returns of Walmart relative to the returns of the S&P. And what you'll find is over a 10-year period, beta for Walmart will change anywhere from maybe down to as little as 0.3 to as high as nearly 1. So beta itself is not, it's stable over a couple of year time period, I believe relatively stable. But when you're looking at over longer periods of time, it is not. So when I see these studies looking at 5 and 10 years, I'm like, well, the beta's changed so much that trying to calculate it and say that it's a different kind of look is almost impossible to find. All right, so we're going to end it by saying your strategy and tip is I always start with top down. I look at the economy, Then I look at the sector rotation study from Jeff Mercer. And finally, I layer anomalies from the industries I like and try to find the ones that are the best deal and have the most positive things going for them. So please don't forget to send emails, Dr. Frank's Finance World at jbawealth.com, and send me some stuff on Ask Dr. Frank. I would like to start up on that. I need to get a number of those before it's all said and done. Anyway, thanks for your time. Have a great day. We'll see you later. Bye-bye.